Good afternoon, everybody. My name is Carmen Wu. I'm one of the lead financial advisors here at Egan Berger and Weiner. I would like to introduce you to Megan Ramsey. She is our marketing coordinator, and she actually has set up this particular webinar for us. So I wanted to introduce everyone to Megan today, okay? And we're going to get started. The name of this webinar is Guide to the Markets 2024 Outlook. And with us today, we have Jordan Jackson, Vice President and Global Market Strategist at JP Morgan Asset Management Global Market Insight Strategy Team. That's a mouthful. Jordan is responsible for delivering timely market and economic commentary to clients across the country and is frequently guest at Bloomberg, CNBC, and other financial news outlets. He has authored several papers on the economy and market with a focus on public fixed income and monetary policy, and he is often quoted in the financial press. I also know that he now resides in Washington, D.C., and he is an alumni of the University of Virginia. So with that, I'm going to go ahead and have Jordan start our presentation. Jordan.
Wonderful. Thank you so much. Good morning, good afternoon, everyone, and really excited to be here. Maybe if we could turn to the next slide just to kick things off. We're really excited to share that this is now our 20th year of publishing our guide to the markets. And on the Market Insights team here at JP Morgan, our main focus is to try to simplify the complex and to see the present with clarity. And we do that using data points. And our flagship publication is the Guide to the Markets. And we think it's a fantastic resource to be able to bring to the financial advisor community as well as to end clients to be able to just make more informed decisions about their investments. And so we're going to talk about a lot, leveraging our slides from our Guide to the Markets. We're going to talk a little about our expectation for the broader economy. We'll talk about consumers and labor markets. That'll lead us into a conversation around inflation dynamics and how we expect inflation to behave over the coming months. And then we'll talk a little bit about interest rates and how we're thinking about broader portfolio positioning for 2024 and beyond. So with that, let's kick things off with growth. If we could turn to the next slide. Our base case now is for a soft landing in the U.S. economy. And maybe just to take a step back, our outlook for 2024 can quite succinctly be summed up actually using the numbers 2024. So we expect roughly 2% real GDP growth by the fourth quarter of this year, 0 recessions, inflation to reach 2% by the end of the year, and for the unemployment rate to average roughly 4% over the course of this year. So again, 2024, 2% growth, 0 recessions, 2% inflation, and 4% unemployment. So how do we get there? Well, it's been quite interesting from a growth perspective. I'd say the rallying cry from the investment community last year, beginning of last year, was recession. When are we going to hit the recession? How deep the recession was going to be? And even our own models were suggesting that the economy would slide into a recession in the third quarter of 2023. Well, in fact, the exact opposite happened, and growth arguably reaccelerated over the back half of 2023. You can see there on the table to the top left-hand side that by the fourth quarter of last year, year-on-year growth was right at around 3.1%, particularly strong when you think about trend growth rate in the U.S. economy of right around 2%. So ending the year particularly strong. As we look at the first quarter of this year, and obviously we have January data in hand, and we'll be looking at the February data particularly closely. But right now, our models are tracking a growth of somewhere around 2.5% to 3% for the first quarter. So this would be about a third consecutive quarter in which growth is running well above trend. And so we're seeing that momentum that carried us through 2023 carrying us into 2024 as well. And obviously, as articulated on the right-hand side chart, the lion's share of economic activity being consumers and consumption growth, to some extent, your outlook on the economy does hinge on your outlook on the consumer. And so if we could turn to the next slide, the way I've been describing consumers really for the better part of the last couple of quarters has been consumers are bending, but not yet breaking, right? So where's the bend happening? Well, one, when you look at savings data, personal savings rate, all that savings that consumers had amassed coming out of the pandemic have more or less been spent down. And so we are seeing evidence that consumers are dipping into their savings accounts and potentially taking hardship withdrawals from their 401k plans in order to fuel spending. When you look at the bottom right-hand side chart, this is looking at flows into early delinquencies. And so you can see auto loans, credit card loans, those delinquencies have started to rise, suggesting that, again, consumers are coming under a little bit of pressure here. But one of the reasons why I think we effectively avoided a recession in the U.S. economy is because many Americans took the opportunity to refinance their largest liability item, i.e. their mortgage, to 2-3%. In fact, the average effective mortgage rate for those homeowners that have an existing mortgage is right around 3.8%. A big difference if you're stepping into a new mortgage that's in the high 6s, low 7% mortgage rate. And this is very evident if you look at the top right-hand side chart. What that line is effectively showing is overall debt payments as a percentage of disposable personal income. And it's interesting, prior to the financial crisis at its peak, consumers were shelling out over 13% of their income just towards making debt payments. But because you've had this significant refinancing wave coming out of COVID, now that number is sub 10%. And so we think, debt payments and interest costs are very manageable across consumer households. And that has effectively kept us out of a recession, we think, for the better part of the last 2 years. Now, what could keep us out of recession and keep consumption growth going, if we turn to the next slide, it's really going to be a continuation of very tight labor markets. And again, if our base case plays out of roughly 4% unemployment rate, that will be really the third consecutive year in which you've got the unemployment rate staying very, very low. So on this slide here, we're just showing the unemployment rate in gray, and then we show wage growth in blue. And you can see that as of January, the unemployment rate is still sitting at 3.7%. January actually marks the 26th consecutive month in which the unemployment rate has been below 4%. You actually have to go back to the 1960s to have a labor market that's been as tight and as robust as this one has. Now, interestingly, when you look at the relationship on this slide between the unemployment rate and wage growth, they tend to behave as mirror images of each other. As the unemployment rate comes down, wage growth moves higher. And that makes some intuitive sense, right? As the unemployment rate moves lower, there's less and less available workers in the overall labor market. And so companies have to pay up to attract that additional worker. And so that's how you've gotten this sort of inverse relationship over time. And interestingly, even as the unemployment rate has remained very low over the course of this cycle, wage inflation has actually been coming down. Now, even though wage inflation has been coming down, we are seeing early signs that wage inflation is generally stabilizing at around 4 to 4.5%. Now, some will say that that level of wage growth is a bit too hot, particularly for the Federal Reserve and for monetary policy. But we have to remember that wage growth is a function of two things. It's a function of real GDP growth and a function of productivity growth. Now, right now, we've got real growth that's running at about 3%, and you've got productivity gains that are running just shy of 3%. Now, we think over the course of this year, as our base case highlights, you're going to get roughly 2% real GDP growth, but we also anticipate productivity gains of around 2% as well. So what I'm getting at is that you can actually have wage growth of around 4 to 4.5%, while overall inflation in the economy can still continue to trend lower. And so I don't think this tight labor market should be much of a concern for the Federal Reserve. And I think the Fed recognizes this, and this is why they feel pretty confident that they can keep rates higher for a little bit longer. Now, if we could turn to the next slide. This is maybe we'll jump ahead one more slide just for the sake of time. This is another topic that comes up a lot in client conversations, and it actually came up on 60 Minutes a couple of weeks ago with Jerome Powell, and it's the trajectory for federal finances in the U.S. government. And I'll be very candid, we are on an unsustainable trajectory. If you look at the top right-hand side chart, we're just showing here the overall deficit as a percentage of GDP. And if you look at the bottom right-hand side chart, we show the overall debt as a percent of GDP. Now you can see that the debt is expected to reach close to 120% over the next decade. And deficits are expected to continue to rise roughly between 5 to 7% of GDP over the next 10 years. Now, there's a couple of challenges that I want to highlight. First, what we've done on the top right-hand side chart is we've broken out the deficit by the interest component and the primary deficit itself. And you can see that in blue, those interest outlays are going to take up over half of the overall deficit over the next decade. Now, that's a challenge because about 40% of government debt is owned by foreign investors. So you can easily see a picture in which not only is an outsized share of our deficit going towards interest payments, but those interest payments going abroad, sending dollars abroad. That tends to put downward pressure on the value of the dollar and could import some very much unwanted inflation into the US economy. Now, when you think about the primary deficit as well, and maybe focus your attention on the left-hand side of this chart, where we break out overall government spending. Just a quick eye look, you can see that about 60 to 70% of government spending is non-negotiable, right? It's in Medicare, Medicaid, entitlement spending, Social Security. I live in DC, and the conversation is around how can we increase defense spending, not cut defense spending. And the reason why I mention all this is because this is effectively crowding out a very important share of government spending, and that's non-defense discretionary spending. This is in sectors like education, transportation, sectors that actually hire folks and pay a wage. That is historically how you've gotten generated economic growth via rising deficits from the US government. And so the picture that I'm painting is not only are we expected to increase our deficits and increase our overall debt, but a lot of that increasing deficits is a function of higher interest payments that are going to be going overseas. And then when you look at the primary deficit, even while the deficit's set to continue to rise, we're not going to be generating the same economic growth that we once did historically by running higher deficits. And so suffice it to say, there's going to need to be some degree of fiscal austerity that hits the US government, either by way of higher taxes or cutting spending. Now, as we know, the challenge is neither side, whether Democrat or Republican, wants to run on that campaign. And so this is a real challenge. We don't think this is a near-term risk for the markets. This is certainly a long-term risk that we're watching. And generally, this poses the risks of higher inflation, higher interest rates, and lower real economic growth coming out of the US economy over the very long term. But again, not a near-term risk, but something that we're keeping our eyes on over the next few decades. Now let's turn to the next slide. I want to spend some time talking about the equity backdrop. And we're actually quite constructive on the equity market this year. I think the equity market is going to deliver somewhere to the low double-digit total returns over the course of this year. And I think it's going to come from about half of that return coming from the Magnificent Seven. And I think the other half is going to be the other areas of the market that are finally going to play some catch up after lagging for most of 2023. Now, on the fundamental backdrop, the left-hand side chart just looks at year-over-year growth and pro forma earnings per share. We've broken this out in margins, revenues, and buybacks effectively. But if you look at those darker green bars to the right-hand side of the left chart, we show bottoms-up analyst estimates for where analysts believe earnings are going to grow over the course of the next 2 years. And you can see that right now, analysts are calling for about 11% earnings growth this year after roughly flat earnings growth last year. And remember, earnings are the fundamental story behind stocks, right? We buy stocks because we believe that earnings are going to grow over time. And in a backdrop in which earnings growth is expected to be decently positive over the course of this year, I think that provides some fundamental support for stock prices over the course of this year. Now, our models are a little bit more conservative than that 11% number, but I will say one thing, that 11% has actually been adjusted lower since the start of the year. Analysts came into the year expecting about 14% earnings growth, and that number is now down to about 11% growth expected for this year. Our models were also coming in a lot more conservative. We were calling initially at the start of the year of about 3 to 5% earnings growth, but it does appear that we're now converging with our macro models kind of owning in on around 8 to 10% growth. And it does appear that those micro or analyst estimates are coming down to roughly the same, roughly 8 to 10% growth this year. That is a supportive backdrop, right? 8 to 10% earnings growth in a calendar year is supportive, I think, for equity markets, particularly after a period in which most of the return on equities have come from valuations moving higher, not so much from earnings actually being being delivered over the last couple of years. Now, if we turn to the next slide, as I mentioned, market concentration has been a big theme over the course of last year, and I think will continue to be a big theme over the course of this year. Now, we've scaled this page out to look at the top 10 names in the index. So you're still including the Mag 7, but you have a couple of other companies in there. But on the left-hand side chart, the green line shows the performance of the top 10 stocks in the S&P 500 going back to the beginning of 2023. And right now, those stocks are up about 80% over the last 13 months. But the rest of the market, which is in the blue line, is only up about 10%. And look, if I think the market is going to have a strong year this year from a return standpoint, then the big boys have to do well, right? They account for about a third of the overall index, which we show on the top right-hand side chart. And actually, if you look at the bottom right-hand side chart, which shows the earnings contribution to the market by the top 10, that number has actually spiked higher as of late. It is now closer to around 30%. So these big companies are actually generating earnings, right? They're actually delivering on earnings growth. And had it not been for the Mag 7 delivering roughly 30% earnings growth over the course of last year, our earnings for 2023 would have actually been negative, right? So these companies are actually meeting and beating very, very lofty earnings expectations. And that's why I think you're going to have a market in which this year, the Mag 7s are going to continue to be magnificent, but you're finally going to get the rest of the market that starts to play a little bit of catch up. If we turn to the next slide, and maybe we'll move forward one more slide just for the sake of time. We often get asked a lot of questions. Obviously, we have a supportive earnings backdrop, but we get asked a lot of questions around value versus growth. Which one do we like in this environment? And I do think in an environment in which the Fed is expected to be cutting interest rates over the course of this year. We think they start cutting rates in the second half of 2024, that I think growth is going to lead the charge over the course of this year, right? Because directionally, it's assumed that rates are going to be coming down and investors are going to be willing to pay up a higher valuation for that growth premium. But thereafter, what we've done on the right-hand side chart is we've actually looked at value performance and growth performance, but under different interest rate environments. And so if you focus your attention to the middle of that chart on the right-hand side, this is assumed that US 10-year Treasury stabilizes at between 3 to 4%. Now, right now, the US 10-year is right around 4.3%. I have a year-end 2025 target. So in about another, call it 22 months from now, I think the US 10-year will be at a range between 3.5 to 3.75%. And in that environment, historically, you have seen both value and growth perform almost identically with each other. And this is looking at returns going all the way back to 1979. And so I do think that while growth may lead the charge, thereafter, we're going to be in an environment in which interest rates are higher and investors are going to want a healthy balance of both value and growth, but particularly with a focus on quality companies and businesses that can generate profits in an environment of a higher cost of capital. Now let's turn to the next slide, because we also get asked a lot of questions of where on the market cap spectrum do we like, right? Are we still biased towards large cap, or do we like small cap companies? In our portfolios, we're biased towards larger cap companies, and we're also biased towards the US relative to international today. The reason why we're biased towards large cap over small cap, while you may get better diversification by looking at small caps, which we show sector composition on the left-hand side, if you look at the top right-hand side chart, on a trailing 12-month basis, about 40% of small cap companies are unprofitable, right? And in a higher interest rate environment, you really want to look at quality, you want to look at cash flows, you want to look at profitability. Those are the main components that you're going to want to be focused on for looking at corporate fundamentals. And if you're just buying the Russell 2000, a small cap index, you're getting a lot of exposure to companies that just aren't generating any profits. And then when you think about the interest rate environment, the fact that the Fed funds rate is at above 5% today, and you look at that bottom right-hand side chart, in green, we show that almost 40% of small cap debt is floating rate. And so not only is a significant share of small cap companies unprofitable, they're also feeling the pressure of higher interest rate that's been delivered by the Federal Reserve. And that's obviously going to have a negative impact on margins and it's going to have a negative impact on small cap profitability. So this is a backdrop in which, again, where we maintain a bit more, we're more geared towards large cap relative towards small cap. But obviously, if we do see signs of the economy maybe re-accelerating here, we do think that would get us a little bit more interested in small cap, just given how deeply discounted from a valuation standpoint they are relative to their large cap peers today. Now let's jump ahead one slide. I won't spend too much time on this slide just to talk about inflation. There's been, I don't think the Fed should take a victory lap just yet, but I do think that there's been a lot of progress on the inflation front. We've seen inflation come down from peak rates of around 9% in the middle of 2022, and we're now down into the threes from a year-on-year perspective. Our base case is for inflation to continue to move lower. Again, we think inflation is going to continue to disinflate to around 2% by the end of this year. I will be honest, though, I think the inflation outlook is one where most of the risks sort of lies, right? When you look at the supply chain issues happening over in the Red Sea, in the Suez Canal, droughts in the Panama Canal, a lot of goods flow through these parts of the world. And this does pose the risk of freight costs moving higher, producer prices moving higher, and that forces businesses to have to charge more for the goods that they're providing to consumers, and that generates higher overall inflation. At the very least, the dynamic here could sort of stall out the march towards 2%. At worst, this could allow inflation to begin to reaccelerate from here. But again, our base case, we are nowhere where we were in the throes of COVID in terms of supply chains. And so we think the price pressures, at least here in the US, are going to be somewhat muted. But I wouldn't be surprised if you continue to see 3% handle on inflation over the next couple of months, while you see the bulk of that kind of disinflation materializing over the back half of 2024. Now, how does this all feed through Fed policy and monetary policy? If we turn to the next slide, it's been really interesting, right? As soon as we had the December FOMC meeting and Chairman Powell sort of leaned into the idea of cutting interest rates in 2024, the markets just took it and ran with it. At its peak, the markets were anticipating that the Fed is going to cut rates 7 times over the course of this year, right? That's almost cutting interest rates by 2% in a very, very short period of time. And historically, when the Fed cuts rate that quickly, it's in response to a recession. But again, we're not seeing signs of a recession playing out. And actually, the data has been quite resilient when you look at both labor markets as well as the inflation backdrop. And so as a result, the markets have gone from pricing in 7 rate cuts from the Fed to now pricing in just 3 rate cuts from the Fed. And by the way, the Fed has been signaling that they were only going to cut rates 3 times since December. But the markets weren't listening. But now that you've got the hard data in hand that is supportive of the Fed not having to be on a rush to cut interest rates, the markets have finally capitulated and are much more closely in line to what the Fed is currently calling for. And that's very evident that we show on this chart here. So the far right-hand side of this page, the blue diamond shows the Fed's estimates for where they think policy rates will be at the end of the year. And then the green diamond shows the market expectations. And generally speaking, the market is now finally right in line with the Fed's estimates of interest rates as of their December meeting. Now, if we turn to the next slide, and again, maybe if we jump forward one more slide, yes, we're confident about the equity market. We think it's going to be a good year for equity markets, but we also like the income generation that you're now getting in fixed income again. And when we think about the risk-reward trade-off between bonds and equities, remember on the bond side of things, we like when interest rates come down because that means bond prices go higher. We don't like when interest rates move higher because that means bond prices come down. And the right-hand side chart is an interesting one. You look at a variety of different bond markets on the right-hand side, and then the blue bars shows what your total return impact would look like if interest rates were to fall by 1%, right? That's a good thing for your bond portfolio. And then the gray bar shows what would happen if interest rates were to rise by 1%, again, which is generally a bad thing for your bond portfolio. And if you just look at the US aggregate for an example, focus your attention to the middle of the page there on the right-hand side. The US Ag is generally considered to be your core fixed income benchmark here in the US, Right now, it's yielding about 4.9%, pretty attractive, decent yield. But if interest rates were to fall by 1%, so the yield on the US ag goes from 4.9% down to 3.9%, you'd be looking at a low double-digit total return coming from the ag. We estimate about 11% total return coming from the US ag. Now, if rates were to rise by 1%, and remember, the yield is a function of the coupon that you're going to clip along the way. So now that you're getting close to 5% of income, that can offset some of the price losses if interest rates rise by 1%. Your total return, which is inclusive of both the income and the price impact, you'd only be down by about 1%. Right. And so I think when you like the risk reward profile is quite favorable from the bond market, given that yields are a lot higher today than where they've been in on average over the last decade. And then maybe if we jump ahead a few slides and just wrap on the policy slide for a second, obviously in a heavily politicized year, it's an election year. So politics are top of mind for everyone. I think I just want to gently remind folks that political views are best expressed at the polls, not in portfolios. We should not allow how we feel politically to dictate our overall investment decisions. This chart here, the red line shows Republican consumer confidence, and the blue line shows Democrat consumer confidence. It's always interesting because both Republicans and Democrats are living and breathing in the exact same economy, but based off who's in office, they feel very, very different about the state of affairs. But take a look at that table on the top left-hand side of this page. Between 2009 and 2017, so under former President Obama, the equity market returned 16.3% annualized. Under former President Trump, from 2017 to 2021, the equity market returned almost an identical 16% annualized return under that period. So if you were a Republican that stepped out of the market in 2009, if you were a Democrat that stepped out of the market in 2017, you would have missed out on very, very strong gains out of the equity market. And so again, this is just a gentle reminder not to allow how we feel politically to dictate our overall investment decisions. By the way, over the last 30 years, which is inclusive of the tech bubble, the global financial crisis, and the pandemic correction, and of course, many different iterations of government, the equity market has delivered 10% annualized over that period of time. And so again, we invest for market cycles, not presidential cycles. And again, don't allow how you feel politically to dictate investments in your portfolio. The last slide here, if we turn to the next slide, just to wrap up really quickly, and then we can open it up for some questions and Q&A from the audience. As we're thinking about our investing portfolio and thinking about our time horizon, our risk profile, above all else, remain diversified within your portfolios. Now, this is a colorful page. We call this our jelly bean chart. I'm more of a Skittles guy, so this will be our Skittles page for today. But each of these boxes represents an asset class. And we've tracked these different asset class total return performance over the last 15 years. What we've also done on that lightly gray shaded box that tracks the black line, this is a globally well-diversified portfolio. It has a little bit of all these different asset classes invested in it. And what you can see is that asset allocation portfolio is never at the top of the page. It's also never at the bottom of the page. It's always hovering right around the middle. And that's really the point of diversification. You diversify so that when one part of the portfolio zigs, the other part of the portfolio zags, and that really helps to smooth out the ride for investors over time. If you look at the two columns to the far left-hand side of this page, we show the annualized return over the last 15 years, and then we also show the volatility of returns associated with each of these different asset classes. And you can see that if you just take that annualized return divided by that volatility, you can get what we call a Sharpe ratio, or a measure of risk-adjusted returns over time. And that asset allocation portfolio, with the exception of high yield, has posted the best Sharpe ratio or risk-adjusted return profile than any individual asset class on this page, just further emphasizing the need for investors to remain well-diversified within their portfolios. And so with that, let me pause there. I know we've covered a lot. Let me pause there and see if we have time to open things up for some questions.
And the question is, do you expect that the TEG, the Mag 7, AI will continue to grow at the similar rate to the trend, and for how long?
We do believe that generative AI is here to stay, and it is going to be productivity enhancing for the broader economy. It is going to be margin improving for a lot of different businesses, and it is not just going to have an impact solely on technology companies. It is going to have broad-reaching ramifications for companies across a number of different sectors. I'll give you all an example. You think about a company like a John Deere, right, and an agricultural manufacturer. They now have technology and are investing more in technologies that can allow these large tractors that can simultaneously zap weeds, fertilize soil, and plant crop all at the same time while the farmers are sipping their morning cup of coffee, right? This is massively productivity enhancing and helping many different business models become significantly more efficient. Not only that, the adoption is probably going to be significantly faster than what we've seen historically from technological revolutions. You think about the introduction of the personal computer, for an example, in the 80s. My boss always jokes that he remembers having to type in DOS into the operating system just to get the system up and running. But bringing computers to the everyday consumer took many years, right? It started out as these huge rooms with huge pieces of equipment to help run the technology. And it took a long time to help train folks on how to open up and use Excel and use email. But now we have all that data ready on a smartphone, right? And so the adoption of all this is significantly quicker, right? It took Instagram 2.5 years to reach 100 million users. It took TikTok 9 months to reach over 100 million users. It took ChatGPT less than a month to reach over 100 million users, right? Because it's so easy to just go online on your smartphone or on a desktop and use something like a ChatGPT. So, this is real. This is transformative, we think, for the economy, and we think the earnings growth, while it's gradually going to step down, it is going to level off at a higher trend growth rate than what we would have expected to see in the past.
Okay. All right. Thank you, Jordan, for that answer. I know that we've been having a lot of changes in the IA industry, and I think it's just beginning. How long do you think this AI trend will continue?
I think it is going to continue for indefinitely, in perpetuity, because it's a technology that continues to advance on its own, right? The more data that it has access to, when you think about large language models and it gaining more and more instruction from human interaction. I think right now, from a labor market standpoint, we're in this sort of co-pilot phase, right, where AI is working alongside human beings. Then we're going to move into a sort of an autopilot phase. And so I think as we start to see more and more of this play out, this is something that is going to play out over the next 15 to 20 years and potentially even further on down the future. I think there's so much possibility out of this technology, and we're just scratching the surface. The opportunity, I think, is very, very strong.
Thank you, Jordan. Thank you. Another question, and now we're going to shift over to the bond sector. What do you think is in store for the bond market, given the expectations for interest rates eventually to go down? Would this be a positive or a negative?
So interest rates coming down would be a very, very strong positive for the bond market. And I've been cautioning investors not to have a 1-year outlook on rates, but to have a 2 to 3 year outlook on rates. Because over the near term, you have to remember that interest rates, while they're obviously impacted by what the Federal Reserve is doing from a monetary policy perspective, they're also, particularly long-term interest rates, are also impacted by things like inflation and real growth. And right now, we're in this environment in which growth is remaining very, very strong. We're also in this environment in which inflation does have the risk of potentially moving back higher, or at least leveling out at around 3%, while the Fed wants it at around 2%. And so there is risk for, let's say, the US 10-year to go from 4.3% to 4.4% or even 4.5%. But critically, we don't think over the near term that we're going to see the US 10-year reach 5% like where we were at in October of last year. We think at best, rates stabilize in the near term at right around 4.3, so you won't see a whole lot of movement. At worst, you see modest upward movement in long-term interest rates by about 10 to 20 basis points or so. But as I mentioned, over the longer term, and as I look ahead towards the end of 2025, for an example, I have a year-end 2025 US 10-year outlook of 3.5 to 3.75. And so if that plays out, you're talking about modest downward pressure in long-term interest rates, again, over the roughly next 18 to 24 months. And in that environment, you will not only clip a nice income, right, along the way, an income of around 4 percentage points or so, but as rates come down, you're also going to benefit from those bond prices or those bond values moving higher as well. And so I think you put all this together, this suggests that over the next 18 to 24 months, I think you're going to get some pretty nice returns coming out of the bond market, whether you're looking for just good income, good quality, stable income, or if you're looking for some price appreciation as well.
Okay. All right, Jordan, thank you. And we have more questions here. This one is actually going back to AI. Hold on a second, let me get the question.
Okay.
All right. Could you talk a bit about the potential detriments of AI on different corners of the market, particularly in the context of the different future projects, different future projected in iterations of the AI that you mentioned?
So the biggest detriment that I think AI will have is on the labor market. And particularly on the lower skilled parts of the labor market. And so the reality is, right, I already talked about an environment in which potentially AI is going to replace things like warehouse workers, many task-oriented jobs that can easily be done by robotics. And so, some analysis would suggest that AI will remove roughly 5 to 20, anywhere between 5 to 20 million jobs in the US economy. But we also have to remember that while it may remove some of those lower skilled jobs, it's also going to create an abundance of jobs. And there's an interesting statistic, right? When you think about the ATM, the introduction of the ATM, and the fact that more and more ATMs were being brought and consumers were able to go to an ATM to access their capital. One would think that as more and more ATMs, right, got increased throughout the economy, that you were going to need less and less bank tellers, right? It was going to remove the need for bank tellers. But interestingly, once you got to the turn of the century, you saw the exponential rise in ATMs throughout the broader economy, but you also saw a rise in the number of bank tellers. Now, why was that the case? Well, the fact that more and more people were going out to use ATMs, that would suggest that there needed to be more and more locations, i.e. more branches of banks in order to house those ATMs. Now, as more and more people began to use ATMs, they began to recognize that, well, maybe I can step into this branch and get other of my banking needs met. And so actually, while you saw an increase in ATM usage, you saw more and more bank tellers as more and more branches were created throughout the economy, and you saw more and more banking services being provided to consumers more broadly. And so, I think while it is going to remove some jobs, it is going to create a lot of jobs as well. And I think that that's really the biggest kind of negative sort of impact that it could have. AI could also increase overall income inequality, right? The reality is, as many of these businesses and companies are leveraging artificial intelligence and helping to improve a lot of those business models, many of that capital could flow into asset owners and not employees, right? And so there could be an increase initially at least in income inequality as well in the US, which is already a pretty significant problem. So those would be the two areas that I think could be somewhat negative when I look at the potential impacts of artificial intelligence.
Yes, there's many changes that I think we're expecting in the next 5 to 10 years and beyond, I'm sure, with regards to AI. So thank you on sharing your views on that. With that, I think we're pretty much done with questions. So from this point forward, what I'm going to ask for the attendees here is that if you have additional questions, please reach out to your advisors, and they will be more than happy to address any other questions that you have with regards to today's webinar. So thank you so much, Jordan, for addressing all these issues, and your presentation was extremely well received. Thank you again for your participation and the support of JP Morgan. And we appreciate your time. And this video will be available to our clients, and Megan will certainly distribute the webinar, or she will let our clients know when the webinar will be available for your view. All right, with that, I thank all of you for your participation. And again, we'll have continuous webinars coming out throughout the year. We usually have 4, but I think this year we're looking to have a little bit more than 4 webinars. So stay tuned and look forward for some announcements on webinars to come. Again, thank you.
Thanks, everyone.